Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. This is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any mentions of rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing company, not guaranteed by any bank or the FDIC. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean that the advisor has achieved a specific level of skill or ability. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal or tax advisor to be sure a Roth IRA conversion fits into your planning strategies. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.
Retirement and risk. They go hand in hand like peas and carrots, burgers and fries, Milli and Vanilli. And today, we're tackling how to eliminate the risky business from your retirement planning journey.
And now, how to retire with Fuchs Financial.
The main thing for the majority of the listeners out there who are approaching retirement is I don't want to be surprised.
Helping you build, preserve, and manage your wealth.
You got Roth IRAs, you have individual accounts, and finding the right taxable strategy, that's going to be huge for you.
Welcome in to How to Retire with Ben Fuchs.
Milli and Vanilli, really? Well, yeah, we'll talk about that in just a moment. Wow, how about those show writers today? All right, welcome into the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. Here to help you take charge of your money is Ben Fuchs. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years in the business. Want you to get the How to Retire Blueprint. It is a vital part of your retirement journey. 800-380-8985. Let's welcome Ben in. Ben, welcome back. Where you been?
Just hanging around, traveling here and there, just hanging out, man. But can we talk about Milli and Vanilli for a second? Is that
sure, exactly.
So I think that the writers put that in there to give us the opportunity to recognize how many advisors out there might have imposter syndrome.
Oh, I see.
So this is not in the show notes. This is nothing, but I will tell you how I can spot an imposter advisor. Do you want me to?
Yeah,
can I lean in a little
let's talk about that. Yeah, go ahead.
So first of all, there are a lot of great advisors. There are a lot of people that really know what they're talking about, that have people's best interests at heart. But when you see an advisor and they've been in the business for 6 months and they're wearing gold cufflinks and a 3-piece suit with the thing flopping out of the pocket, right? And the fluffery. To me, that's somebody where I'm like, oh man, you're trying to really like paint an image because you might be worried that you don't really know what you're talking about, and so that's like the Milli Vanilli part of the advisor piece. So is that a fair comparison?
That's a very fair comparison. All right, so we'll keep our eye out for that kind of guy because we need that guy.
Am I being too mean? I remember, my story where I went back to college after they politely asked me to leave at one point, right? That's,
yeah, that can happen.
So as I'm trying to find work while going back to school, I remember interviewing for different sales jobs, and one of them was with a big company that shall not be named because I don't want to get sued. And the guy was telling me how I would just make a ton of money if I worked at his company, and he had the shirt with the 2 different collars, 2 different color collars, and he had everything was so flashy and so like in your face and all about like how well off somebody was that it absolutely turned me off. Which isn't to say that people can't have that, right?
Yes.
People like cars. Cool, man. I'm happy for you. You like nice clothes like that. That's great. But if it feels like someone's putting on a costume, that's when I feel like I get a little bit of an itch inside of me, and I don't want to deal with those people.
No. And Ben's real. I mean, we while there is no video that you guys can see, I can see Ben, and he looks like the regular dude. I mean, he's dressed nice. I mean, he's not, shorts and t-shirt. No. Yet.
I have found that every year in business, I start dressing down more and more. So, they're like, I haven't found my floor yet, Gary. We might get there.
Okay. Well, watch out for those guys because, but seriously, we talk about all the accomplishments that Ben has at the start of the show because it's really important when you look for a financial advisor that you find someone that's competent in what they do and been around for a number of years like Ben. So there you go, Ben.
Thank you, Gary. I appreciate
congratulations on all your success here. Have a good day.
That's all I needed, Gary. Thank you, man. I'll see you later.
All right. So anyway, let's get into the show here. We're diving into critical types of risks that can impact your retirement planning. Understanding these risks can help you prepare for more secure and comfortable retirement. Let's break down a few of these common risks and how you might see them in your financial planning journey. All right. We're going to talk about inflation. No, inflationary risk. Yeah, really? Come on now. Seriously?
Look, seriously. Listen, it doesn't matter how many times we've talked about something. A lot of people have not heard it. A lot of people don't quite understand it. And to be fair, Gary, you phrase it a little differently every time, so it sounds new to everybody. And for that, I'm grateful. But
that's my job.
Yeah, fair. But listen, inflationary risk. Inflation erodes the purchasing power of your money over time. Even if your savings grow, if inflation outpaces your investment returns, your money might not stretch as far as you'd hope. What does that mean? So, okay, cool. I'm getting 4% in my bank savings account, if you're lucky, maybe 3%, maybe 5% if it's in a money market. But if inflation is growing at 8, then inflation is outpacing your savings. Mm-hmm. And so we need to look at different areas, different options to where we can make sure that your purchasing power, that your savings are not eroded by inflation. This is one of those things that we talk about a lot, but one of the things that we worry about, right? How will this manifest in the financial planning process? What kind of impact does it have? In order for us to combat this, we got to consider investments that typically outpace inflation, like stocks or inflation-protected securities. The issue that we see, and Gary and I talk about it a lot, is that some people are ultra conservative. And I understand the need for being conservative. And I had a friend tell me recently that he liked my radio show because, Ben, it sounds like you're not actually just trying to shove a product down my throat. You're trying to actually help and teach me. Right. And so this is one of those scenarios where I think a lot of people are trying to make people really conservative and only use things like annuities and savings. And being safe is good, but you also need to have a mix. Having a mix of safety and risk is better, and that is the reason why.
Mm-hmm. Someone gave me this definition of inflation, and I don't know if I have it right, but you'll tell me if I got it right or not. Too much money chasing too few goods? Is that the definition of inflation per se?
Yeah, that's fair. I mean, nobody was flying airplanes during COVID, right? The last thing we wanted to do was sit 3 apiece in sardine cans, breathing the air of somebody next to us when we thought everybody was going to kill us.
Yes, exactly. Yeah. Fast
forward a couple of years, we don't have to worry about it anymore, and now we all want to see the family that we neglected and go to the vacations that we didn't go on. And so now, surprise of surprises, ticket prices have gone up, carnival prices have gone up, all those things. And so, yeah, that's exactly what that is. You have a lot of people trying to buy something that is limited quantity. It goes back to your basic supply and demand chart in economics in high school, right? The greater the demand, the less the supply, the more prices will naturally have to be raised.
Market volatility risk. You mean the market goes up and down? Who knew?
Listen, I know this is a stunning concept, but the stock market can be volatile, and market downturns can impact your retirement savings. There was a week over the last couple months, I forget exactly which one it was, where every single day in that week, the S&P 500 ended higher than it did the previous day. Right?
Yes.
But in between, it might have dropped 1% or 1.5% and then gone back up. So if you're the average investor and you're just looking at the end day results, you're like, oh, this is great. Everything is going up. But in between that, oh man, there was a lot of volatility. And, you can look at that from a day-to-day perspective, which is like, somewhere in the last couple of weeks. Or you could look at it in 2020. If you look at it from year beginning to year end, you would say, man, the S&P 500 went up by like 15, 16%. I forget exactly what it was. I know I'm going to have people sending me hate mail because I got it wrong. Don't care. Moving on. But again, 2020 was a crazy volatile year. That was during COVID. We saw the S&P 500 drop from its high at one point in the year, go down by 33% and then end the year higher than it even started. So again, if you're looking at the January 2020 to December 31st, 2020, you're like, oh, no big deal, it went up, great. But in between then, there was a lot of heart palpitation. A lot of people actually lost a lot of money because they panic sold. So again, market volatility risk is a big thing. And what we've seen in the last 4 or 5 years was that the market has recovered pretty quickly, right? It went down.
Yeah. Yes. Yeah. I think from 4 years ago, it's up like, I mean, the Dow Jones average is up like, what, more than 50% or 100% the last 4 years, something along those lines, I think.
Some
don't
very,
have the numbers were correct, but yeah.
Yeah, some very significant growth. But in the past, we haven't seen that kind of quick recovery from a market downturn. It took like over 900 days for from 2000 to 2002 for things to start to recover, to get back. I mean, here it takes more than 3 days to recover, and people think the sky is falling. Market volatility is a part of the plan. It is a part of the expectation in retirement. And if we are not planning for it and planning for more than we've seen lately, we're doing the wrong thing.
And I hear that phrase too, that when market's down, stocks are on sale. So wouldn't that be the best? You don't want to pull all your money out when it's down because you're going to lose out a lot of money. But shouldn't you at least to try to acquire more when it is down like that, thinking that it will recover, Ben?
I mean, it depends on who you're asking, right? I mean, sure, if we're working and we're contributing to our 401ks, absolutely. We want to be trying to raise our contributions, maybe even buy into indexes and markets outside of the 401ks and the retirement plans. Great. Definitely no question. But if you're already retired, you're saying, well, where is that money going to come from that I'm going to put into the market? From your bank account? Maybe. Right? From the safe side of your investments? Yes. That is a whole concept. That's why you need to have a blend of different investments to over time. And I look at buying in the market when it's down a little bit like diving into an ocean wave, right? If you dive into the ocean wave and you do it right, you're not going to get hurt when that big wave comes. But if you just stand there and let it hit you in the face, that's when the pain comes, Garrett. Yes. So listen, we offer what we call a How to Retire Blueprint. And really, I got to change the name because it feels a little gimmicky to me. I'm not really offering a book or a pamphlet. What I'm offering is just the opportunity to come and talk to a real human being about your situation. And I think for a lot of people, you're like, well, I don't really want to commit to a 60-minute conversation. I don't want to do that. Maybe I could just have a phone call, explain my situation, and see if it makes sense for me to even come in for an appointment. Okay, no problem. Give us a call. Tell us what you'd like, and we'll get back to you, and we'll figure out a time that we can have a phone call and just go through your scenario, where if that's, can we talk to me about when to take Social Security? Or I feel like I'm paying too much in taxes. Or I've had the same advisor for the last 20 years, and I have no idea if I'm actually on the right track. Or could you just give me a second opinion? Maybe they're doing everything great by me, and I just need to get confirmation that I'm on the right track and I'm doing great. No problem. That's what we do. We're happy to do it. But in order for us to do that for you, you do have to actually pick up the phone and give us a call.
He's letting the clock run out on his Social Security to age 70 for maximum benefits. And here comes the Roth conversion. He's locked in for income for life. He's got some outstanding coaching with that annuity plan. He's created his own pension as well. And it looks like he's going to go all the way.
Play your best retirement game. Call Ben Fuchs at Fuchs Financial, 800-380-8985, 800-380-8985.
Welcome back to the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. Back with us to help you take charge of your money is Ben Fuchs. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years experience in retirement planning business. I always tease Ben about all the letters after his name. You got a lot of letters there, don't you?
Hey, man, listen, I'm trying to get the whole alphabet. I'll get there later.
But you've earned every one of those. Yeah.
Theoretically. I just paid off a lot of people in the CFP office. No, absolutely not. Let me take that. Please redact that from the... No, I did not pay off.
Wait a minute. Hold on.
No.
That's wrong.
Oh, okay. Got it. Thank you. It's nice when you have a on-hand compliance department. Thank you, Gary Nolan.
My pleasure. Absolutely. All right. So we're going to continue diving into the crucial types of risks that can impact your retirement planning. We talked about inflationary risk. We talked about market volatility risk. Here's a big one. We could spend a whole, show on this one. Healthcare risk, man. It's really important.
Yeah, I mean, look, we know that healthcare costs rise over time, and they obviously can be a significant expense in retirement. And I think that's one of the greatest fears and one of the biggest unknowns. I can say a couple things about Medicare very quickly, or about long-term care planning, which is one of the biggest concerns that a lot of people have. In terms of long-term care planning, there are some new products out there, things that we would actually sell you. I'm sorry. That might actually help you from a long-term care perspective. Traditional long-term care I've always shied away from because, not that we don't get a great commission from it. We do. Thank you very much. I know you're very concerned about how we get paid. But the concern that I've always had is we might be paying $8,000, $15,000 a year. Do that for 30 years, you put in $450,000 and then never need it and get no value from that insurance. And to be fair, the best outcome that we can have is to not need long-term care insurance. However, I'd like to have something in mind that if something happens to me, that there's some kind of coverage. And so what we've seen are there's some upfront products that people have used where, you might put in $200,000 and you might get $600,000 worth of coverage in the event of a long-term care piece. And by the way, if you don't end up using it, then that original money is able to grow at a decent rate, at a decent interest rate. Now, that's not guaranteed for everybody, but you also don't have to get your blood pricked for medical testing on some of these. So if that's a concern for you, I would say that we have something that might work and you can give us a call. I think one of the main reasons why you call people like us is because there are so many instances where you just don't know what you don't know. And one of the things that we can do is show you the options that are available to you and then let you decide whether or not you want to do it or not. I don't care if you choose to do it or not. It doesn't really affect my day-to-day life, but our goal is to put you in a better position than when you came in. So that's what we're looking at. Now, as far as Medicare goes, I am admittedly not the expert. Gary, you heard it, right?
I heard it. Yep,
Okay.
I heard it right here.
So, much as I hate to say that, I am not the actual expert. However,
But you got a guy.
I got a guy, right? Yeah. I'm not changing the engine on my car. I'm not performing my own shoulder surgery if I got a rotator cuff tear. I'm not doing my own Medicare. I've got somebody else that's going to put all the numbers together and help me decide who is going to give us the right plan. Now, Fuchs Financial gets a commission every time that guy sells somebody, that's the technical term, a Medicare policy, right? If somebody helps them with a Medicare policy, we get a commission. Thank you very much. I appreciate that. But that guy is on salary. And the reason that he's on salary is because I don't want his commission to influence the direction that he goes for any client. And that will continue to be the case. There's nothing there. It is a strictly salaried position for us for that reason.
Right.
Because,
Makes sense.
Should you be on the Advantage plan? Should you be on the Medigap plan? Do you travel? What are your medications? I mean, to be fair, there's a whole lot of work that has to go into that stuff if you're doing it right. But it can be done, and it can be done relatively simply. And frankly, I'd rather have somebody else that has my best interest at heart working for me and helping me figure that out than trying to do it by myself.
Right, and that's part of your fiduciary responsibilities, Ben, and that's a great example right there. Here's one that is commonly forgotten about this type of risk, Ben. It's one worth discussing, though, because this can cost you literally thousands and thousands of dollars if you don't do it right. The sequence of return risks.
Yeah, so remember that example that I talked about in the previous segment. And if you weren't in the car at that time, shame on you. You should be listening to me for the entire hour. You're doing the wrong thing. So is that okay from a compliance standpoint?
Perfect. Absolutely perfect. I'm in total agreement with you.
It's rare, but it happens. People,
yes,
you heard it here first. All right. So sequence of returns is a big concern. What that really means is what happens if the market is down for the first 1, 2, 3 years that you're taking out money. And again, we talk about the rule of thumb that gives me the most heartburn, the most heartache, the most frustrating part of the plan is this 4% rule.
Oh, so yeah.
Let's take that into consideration and let's just play this out from 2000 to 2002. Okay? So I've got $1 million in my 401k. I'm going to take out $40,000 a year, 4%. Cool. S&P 500 goes down 10%. I had 90,000. I go from $1 million to 900,000. I'm taking out 40,000 on top of that. Now I have 860,000. Okay. Next year, the S&P goes down by another 13%. I'm not doing the math on that in my head. Sorry, guys, but let's say it's another $100,000 that it drops.
Okay.
So it goes from 860 to 760, and then I take another $40,000 out. Okay, so now I'm at 720. And then the next year, in 2002, the S&P goes down by about 23%. So let's just make it easy, and we'll say about $200,000. So I was at 720. Now I'm at 520. I take another $40,000 out. Now I'm at 480 after 3 years in retirement. How am I going to get back to even?
That's a pretty tough putt to make, I think, right?
Yeah. And then, oh, by the way, let's not forget that just a couple years later, we had 2008 where the market went down by another 38%. And so sequence of returns is incredibly important. We need to plan out what would happen and will your retirement survive these downturns in the market? What is the plan for you to make sure that, when the market goes down, not if, but when it will go down. We just don't know when and for how long. that you have a plan and that you know exactly where your money is going to come from so that you can sleep at night. Look, how many people of you have anxiety every time the market drops by 1%? Well, think about it being down over 40% over a 3-year period, which, right? I mean, listen, how many people were looking for jobs in 2008? Mm-hmm. You don't want to be having to go back to work because your market, because the economy fell so much, right? Because your account dropped so much, especially for a lot of people. I tell somebody, I can't predict the future. I have no idea if the stock market's going to go up or down over the next year or two, right? I think over 10 years from now, I expect the stock market to be much higher than it is today. But I can't guarantee that it will be higher in a year or 2 or 3 from now. I can't guarantee anything. What I can do is put you in the best position that we can for retirement. And by putting you in the best position for retirement, for me, that means making sure that we know exactly where to get money when the market goes down and being able to capitalize when the market goes up.
So what is the alternative to the 4% rule? Just having a great comprehensive plan that takes all that into account, Ben, pretty much?
Listen, man, I'd love to make everything like a cute little catchy phrase and say,
sure.
Hey, the 4% rule, the 60-40, the 100 minus your age.
Yeah.
You know, don't nonsense, all of it to me. Every little, look, everybody's situation is different. Why is one rule of thumb going to apply to everybody?
Right.
You know, I mean, most of us can't pick individual stocks like Warren Buffett, right? But a lot of us can't handle the risk of having everything in the S&P 500 either. And shouldn't, by the way. I mean, I think for a lot of people, as they're approaching retirement, that's the time to take the foot off the gas and say, look, I just need to make sure that I can do everything that I want to do. And then we build off of that standpoint. What are we spending? Is it $5,000 a month? Is it $50,000 a month? I don't care. But let's see what it takes from your investments to generate that income with a plan, with the backdrop, with the safety net, with aggressive growth, with, conservative safeness in between. Let's generate that income. Let's maintain the principal. Let's do the things that we want to do. But, we need a real plan for that. And there's no phrase that I can give you. But that's what we call our How to Retire Blueprint, because we're trying to create the blueprint for how you retire. And if you have more questions or you want to see more about that, instead of using my regular website, which is fuchsfinancial.com, which I think most of you are like, how do I spell that? And am I going to spell that wrong? Am I going to get arrested by Google for misspelling his name?
Oh, gosh.
What I did was we just bought a new domain, and it's taxesandincome.com. Okay, it's taxesandincome.com. So that way you can go through, you can see a lot of what we do. You can see the different videos that we have and the things that we put up and how we allocate money. And to be fair, a fair amount of learning on there. We do a fair amount of virtual learning center options on there so that you can understand the philosophy of our firm and understand why it would or would not make sense for you to be a part of it.
All right. Taxes and I missed it.
Income.
Taxesandincome.com, right?
That's it. Yeah. Easy.
All right. We're going to go to it and we're going to check it out. All right, Ben, final thoughts. Oh, I know. I have one thought for you.
Oh.
All right. So when the market goes down, I should buy pharmaceutical companies because people need more meds. What do you think of that? That's pretty good, huh?
Gary Nolan, I think that is absolutely brilliant. And yes, well said, sir. We might need a new vaccine to inoculate us from the market going down. That might be
exactly. Yeah. Let's talk to one of those big companies about it. I'll talk to you after the show about that. We'll work that out.
But if we're going to use actual advice here, here's what I would say. I would say, look, a lot of people are saying, I don't know when I should take Social Security. I don't know how to create a paycheck for myself in retirement, right? I've worked my whole life. Great. I retire. Now what do I do? Do I just take chunks out of my 401k? No, that's the wrong way to do it. We'll give you the right way. And how do I make sure I pay as little as taxes as possible, right? When do I take Social Security? How do I create a paycheck? How do I minimize my taxes? And how do I do the right estate planning so that things go where I want them to go? You give us a call. You do the How to Retire Blueprint. If you want, you can also go to taxesandincome.com to schedule a phone call with us, or give us a call and we can schedule an appointment.
We believe in better. A better way to invest. A better way to serve you. And a better result. We can help you determine how much risk you're taking, red flags that could be potential problems for you, how much you are paying in fees or commissions, potential tax liability, or even how to address Social Security. Call Ben Fuchs at Fuchs Financial, proudly serving all of Connecticut. Call today, 800-380-8985. 800-380-8985.
All right, so let's get started on segment number 3, Ben. Okay, so Christine Benz, she's the Director of Personal Finance and Retirement Planning for Morningstar. She has a new book on retirement, and she interviewed advisors from around the country and lays out what the basic information that she has that we can share with you. So here we go.
People think they're going to travel, they'll spend time with family, but realistically, how much time every day, every week are you going to be spending doing that? What are you going to do on the average Tuesday? So figure out what you may want to do in retirement, who you want to do it with, and where you're going to do it, where you're going to live. And just test drive it. Maybe you take some time off and go to that particular city or go to that place. Check out the lifestyle, check out the location, and figure out if you can do what you think you want to do there. Then also think about how much is it going to cost you to live like that? What is the housing? What is the transportation? What's food? What's everything going to cost? Come up with that retirement budget and see if you can stick to it.
What do you think? Your thoughts on a retirement dress rehearsal? What do you think about that, Ben?
So, first of all, I think she stole some ideas from my head. Christine, we're going to have a conversation later if you're hearing this. You know, if you're very
from your lawyer.
Yes, my imaginary attorney. That's good. Anyway. So here's what I would say. I would say that this is true in all manners of financial decision making. So I think that one of the things that's really overlooked is the mistakes people make really early on in life. Like, yes, we know about credit card debt. Yes, we know not to do that. But, I mean, how many people do you know get their first job? They're making $50,000 a year, but then they've got like a BMW in the driveway. Mm-hmm. Right? I mean, what are we doing, people? Let's, that can't be what we're looking at. So I think what is important is to consider the dress rehearsal again before you do anything. So listen, there's not going to be a point, hopefully, in my life, unless, I really mess up and the business goes under or whatever, where I have to have a roommate again. And I can tell you, once I stopped having a roommate, the last thing that I wanted to do is go back to having a roommate, except for my wife, right?
Yes, of course. Well said.
Right. But let's maintain, equilibrium here in the marriage. But I think what a lot of people do is as soon as they possibly have enough money to go live by themselves, they do it. Instead of saving just a little bit more, saving an extra 6 months, or, saying, look, it's going to cost me X amount of money to move into an apartment, right, by myself. How much more is that? $300 a month, $400 a month? What I'm going to do for the next 3 months, 4 months, whatever it is start putting that extra money away into a savings account and seeing how the rest of my lifestyle feels without that extra money. Right? Mm-hmm. How much extra is going to cost me for electricity, for water, for everything else that's involved in the whole process? Let's look at that. Same thing. I've got a 15-year-old Honda Civic. What happens when I buy that BMW? How much extra is that a month? Let me just stop 2-3 months. I'm sure there'll be a great car deal then. Also, trust me, they have them all the time.
Yep, they do.
Well, though they used to, and now we can't buy a car, so maybe don't listen to my advice. But consider, what is that extra dollars out of my pocket? What does that look like? And if you really want to go crazy, start thinking about, what if I would have put that $200 a month, that $300 a month into an account, put it into the S&P 500, let it sit for the next 35 years and see how much that would grow, and say, well, is it really worth it for me to do that? How much money can I save? Or maybe I could even do that enough so I'm buying that next car cash, right? I mean, there are a lot of ways for us to reconsider the way that we think about money. And I think the problem is, when there are so many commercials, and, I don't even like it when my kids watch the NFL with me, because the commercials in between are like, oh, Dad, what is that? I'm like, listen, you don't need that vodka, 7-year-old. Like, that's not what we're, I know it looks like they're having a great time, but they don't show on the screen that hangover that comes afterwards. I promise you, it's not right. So, and you have money hangovers too, right? I mean, is that like a fair?
No, oh yeah, I got a personal example, to be honest with you, and I'll share a personal story with you. Many years ago, of course, I've been broadcasting for my whole career, and I'm working at a station on Long Island, New York. Long Island, New York happens to be maybe what we would like to call the AAA farm team for New York City, because everybody wants to work in New York City, because that's the biggest market in the country, right? So the bigger the market, the more money in the radio industry. So I got that job in Manhattan at New York City radio station, right? And my income pretty much doubled, Ben. You think I saved any of that? No. Yeah. I immediately, no. I'm wrong. I, hit that buzzer again here, No. I immediately went up to that level. Everything went right up to that level. We changed our lifestyle accordingly. And, that's one of the regrets I had early in my career. And, you learn from your lessons. And that's a perfect example. I'm totally honest with you. That happened, yeah.
Oh, yeah, look, I remember the first time that really struck me was I had a girlfriend many, many years ago. She had a roommate. The roommate was a manager at one of the stores in the local mall. And, like back then, she spent next to $250 a month because she really wanted an Audi. So she got this Audi. Nothing wrong with Audis, by the way. Please don't sue me. But she got this Audi. And, it took so much of her extra income that she could never go out. She could never do anything. She never had any fun. She liked driving to work, but it ended up being the much bigger burden for her. So again, what are we trying to accomplish with these things? So when it comes to retirement, look, I don't want any of my clients to go and buy a house in the Villages or North Carolina or wherever they want to move before they've actually lived there for a couple months to make sure they like the community, before they like their neighbors. All those things are incredibly important. And if you don't like the dress rehearsal, then man, we're glad we didn't really fully commit. So yes, I'm fully on board with that. I think it makes a lot of sense, and there's a lot of value to it.
So we're talking about, planning for your retirement and what's the best scenarios for you and how it differs from everybody else. We talked about the things you need to do before you retire and having a dress rehearsal. How about reconsider your risk portfolio, Ben? You touched on this a little bit already, though. Yeah.
Yeah, again, once you're about 5 years away from retirement, maybe even 10 years away from retirement, in some circumstances, not all, you should consider beginning a defensive investment philosophy. You could have invested more aggressively while you were growing your money, but now would be the time to diversify and reduce your risk to help avoid losing a big chunk of your retirement to a bear market. And yes, I went on about this. You're welcome. But, the 5-year concept, why do we say 5 years? Great question, Gary. Thank you so much for asking.
Just about to ask. Yeah, thank you.
I could see it. Unfortunately, Gary did just tell me I'm number one with his middle finger, but
I did. Yeah, well, yeah.
That's okay. I'm grateful. So when it comes to 5 years, 5 years was the time that it took to get back and recover from the Great Recession from 2008. So if we look at the S&P 500 in the beginning of 2008, once it fell by 36 point something percent or 38%, the numbers get varied from time to time depending on who you're asking. Once it fell by over 36%, we'll put it that way, it wasn't until 5 years later, until 2013, that the S&P 500 got back to even from that time period. So we say 5 years because we don't want someone to retire in 2 years, have the market crash like that, then have to work another 3 just to get their account back where it used to be so they can then now retire again.
Mm-hmm. Also, we have to use the B word. I don't like this, but yeah, it's there. Make a budget. Oh, I skipped one. Let's talk about healthcare first, Ben. Sorry.
Oh, sure. Yeah, healthcare. Yeah. Unfortunate fact of life, healthcare becomes more critical and potentially expensive as we age. Look, we talked about it before. Yep. We can't forget about. One of the ones that I think was up there that we didn't talk about was debt, right? It talks about, a lot of people will say you really need to get rid of all of your debt before you retire. Get rid of it all, the mortgage, the car payment, the credit card debt, student loans, you name it, make it go away. Maybe. But I have some people that have $90,000 in credit card debt and they only have to pay $10 a month on that. Like, just pay the $10 a month. Who cares? Honestly, is that really going to hurt your lifestyle? No, you got the education. Yes, you've got the debt, so be it. And, as far as the home and the car could be different depending on the interest rate that you have. But most people that are retiring now, most of them, not all, got their mortgages when they were under 4%. Some people got them under 3%. I don't want to brag. If you got it under 2%, don't even talk to me.
Yeah, please.
But we don't need to retire that. If we can put you in an investment where your money is making 7-8%, why are we paying off, instead of putting more money into that investment, why would we pay off something that, only costs us 2-3%? We need to be smart with the way that we approach money. We need to be considerate and deliberate. I think that's the problem, is that so many of us, and I'm guilty of it too in other areas of life where I'm not deliberate. I don't make a plan. I just kind of go along with the day-to-day, and I get caught up a little bit. And I think when I really take time to figure out, even with my kids, right? What kind of activities do they need to do? Am I just going to let them do whatever happens, or are we going to be a little bit more deliberate? Hey, man, what do you want to do? I don't know, nothing. That doesn't work. That's not an answer. That's not helpful. Why don't we figure out the things that you like to do so you could be a well-rounded human being? I just want to play video games. Nope. Also not an option, right? And if we're not deliberate and we don't make plans, these are the things that just kind of happen, and day goes by, day by day, and we haven't done anything. Yeah. This is the scenario. So the reason that we offer, our How to Retire Blueprint is so that we can help put you in the best position for retirement. My father used to talk about sports. And he would say, you can't control how the other person trained. You can't control how hard the other person worked or how athletic they are or what they're doing or how well they're coached or any of that. All you can control are the things that you do, how well you eat, how hard you work, how much you've prepared, how you feel as you get into retirement. Our goal at Fuchs Financial is to put you in the best position for retirement, to make sure that we've done everything that we can so that you have a successful retirement. Now, if you want to schedule a phone call, you can go to taxesandincome.com. Again, that's taxesandincome.com. You can also schedule a 60-minute appointment by Zoom, by phone, one of our offices in West Hartford, Middletown, Middlebury, whatever works best for you. But we can't do that for you. You actually have to pick up the phone and give us a call.
Do you ever feel like you're fighting for financial knowledge? Don't let bad advice be a punch in the gut to your retirement. Take advantage of a complimentary, no-cost, no-obligation consultation with a local, trusted financial coach.
Call Ben Fuchs and the team at Fuchs Financial, 800-380-8985. That's 800-380-8985.
All right, questions that came in to us. Here we go. John in Granby. I'm currently 64 years old, retired. I have 2 IRAs. One is precious metal IRA account. The other is a traditional IRA account. I'd like to remove a portion from either of these IRAs and put it into a Roth account. How would I do this with either IRA? It is the same process for the traditional IRA and the precious metal IRA. How much can be transferred into the Roth IRA on any given year? Okay, we got 10 questions in one.
All right, thank you, John. Yeah, no, listen, man.
John, thank you, John.
Wow. Anything else you want to ask?
No, yeah, throw in something else there.
How many different eyelash strands do you have? All right, so the problem for me is that I can't tell you the rules for every single custodian. So a custodian is where the money is held. Think your Fidelities, your Charles Schwabs of the world, your Vanguards of the world. The money is held at those custodians. They have custody of the money. That's the custodian. And so when it comes to like the types of investments, like you can have, Vanguard mutual funds in a Schwab account. You can have Schwab funds in a Fidelity account. Like the investments can be mix and match. It's just where that money is held. So what I can't tell you is where either of those accounts are held. Now, our clients, they're all custodied at Schwab. I use Schwab. I like it. Doesn't mean you have to. Doesn't mean that they're the best. They just happen to be what we consider to have the best combination of cost effective and value for our clients. But, everything is personal there. This is not a preaching moment for me. When we do Roth conversions for our clients, we'll just open up a Roth IRA, fill out a form, and move the money from one account to the other. And depending on the client and the scenario, sometimes we will withhold taxes from the IRA to pay for it going into the Roth so you don't have a bigger tax bill at the end of the year. Okay. And sometimes we'll have you pay the taxes yourself out of the money in your bank account. It depends on the scenarios. I'm not going to go on the radio because I need graphs and charts, and that helps me explain to each individual person why we would or would not do that and why our advisors would or would not do that for each person sitting in front of us. But there's some different pieces there. Typically, what I've seen is that if you get very, very specific with some of the precious metals, some of those can have some really high fees for moving money either into or out of that account. That's not saying that they all do, and it's been a while since I've really had to deal with them. But there was one time when we wanted to get money out, and it was like a 13% fee for my clients to pull money out of these because it was like holding specific metals. So, it depends on the way that things are set up and the way that you do it, but it's going to be different for everybody. In terms of how much can be transferred into a Roth IRA on any given year, there is not a limit. Mm-hmm. You're like, well, that doesn't make sense. Why wouldn't there be a limit? Well, because you add on. So any money that you convert to a Roth IRA, you're basically adding that money onto your earned income.
That's right.
And paying taxes on it. So, you could be at the top of the 22% bracket, convert $100,000 over into a Roth IRA. That $100,000 will now all be taxed in the 24% bracket because it pushed you up to a higher bracket, or go from the 24% bracket to the 32% bracket. So they don't care how much you put in. You're paying taxes on all that money, federal, state taxes. It all depends. And so when you're creating or looking to do a Roth conversion, you need to have a very specific strategy in mind. Otherwise, you could be paying more state taxes than you want, more federal taxes than you want. You could be paying more Medicare taxes than you want. All these things go into the equation. And that's why I look at, have you ever looked at those big, giant ropes that they have on playgrounds where it's like a mesh net, right? And almost like a spider web, right?
Yep.
And so you move any one strand and every other strand is going to move also.
Yeah.
Right? It's the same thing. If you're talking about Roth conversions, yeah, that affects your taxes, that affects your income, that affects your investments, right? If I change your investments or the way that I manage your money, that's going to affect your taxes. It could affect your estate planning, right? Depending on different annuities that people use. Yeah, that's going to have a big impact on every other piece of the plan. And so that's why it's so important that all these things work together.
Mm-hmm. You know what I wrote down here, Ben? I wrote DIY, reminding everybody that it's not a do-it-yourself situation. There's too many moving parts or puzzle pieces, whatever analogy you want to use, and that's why you need somebody like Ben on your team, because this gets incredibly complicated. All right, let's, John, get a hold of Ben and the team. We'll give you the phone number again in just a minute. Gene in Guilford, here's a simple question. Do beneficiaries pay taxes on life insurance?
All right, so Gene, generally speaking, when the beneficiary of a life insurance policy receives the death benefit, this money is not counted as taxable income, and the beneficiary does not have to pay taxes on it. However, a few situations exist in which the beneficiary is taxed on some or all of a policy's proceeds. If the policyholder elects not to have the benefit paid out immediately upon their death, but instead held by the insurance company for a given period of time, the beneficiary may have to pay taxes on the interest generated during that period. Now we're getting real technical. You're welcome, right? So if I have $1 million policy, we elect to not have it paid out after my death. Let's hope I don't go anywhere. And that thing pays out 5%. So, we have it held for a year. There's another $50,000 generated on that interest. You're going to be taxed on that interest, right?
Okay.
Also, when a death benefit is paid to an estate, the person or persons inheriting the estate may have to pay estate taxes on it when it's not going to a person, but an estate. Because it could be over certain limits. There are certain reasons. But so you asked me a very simple question. You're welcome for the multi-paragraph answer, Gene. Anytime I can make something more complicated for you, that is, of course, my goal.
Yeah. No, well, the big part was that when you said however, that's when I perked up. I go, okay, here we go. However, I got it. My eyes open. I go, okay, however. All right.
For the most part, in most circumstances, it's going to be tax-free.
There's always a however in there somewhere. All right, here we go. Harold in Hebron. My partner of 25 years ago passed away 3 years. I'm the sole beneficiary of her IRA. Their IRA was established 12 years ago before her death. I heard the IRS has specific rules and limits and time limits on distribution for non-spouse inherited Roth IRA. We were not legally married. I have not taken anything out of the Roth. What are my options? What are my limitations? What do we have for Harold?
All right, Harold, this is a funky, tricky one. First of all, I'm really sorry. That sucks. I've unfortunately had to deal with a lot of people lately who have lost a partner, and at least you're in a position where you're asking really good questions. I've had a lot of people that come in and they don't even know what questions to ask. A lot of times just finding everything, finding all the different accounts and pieces has been a own unique challenge. When it comes to inheriting Roth IRAs from a non-spouse or a traditional IRA from a non-spouse, it used to be that you could take out a little bit every year, called the stretch IRA, and take it out over your lifetime. They have changed that rule. Now the account has to be fully distributed over a 10-year period. There is still some back and forth between the IRS and the tax advisory world on whether or not you have to take out a little bit every year. But the one thing that remains true is that after 10 years after the death of the person, that account has to be emptied. You have to take everything out, which could be a big deal, because if you have $1 million in a taxable account, you don't want to wait until the very end and have to take out $1 million from that account, plus all the growth that it's had, and then pay taxes on all of it and do it at the highest tax bracket, the 37% bracket, the 7% state bracket. Wherever we are, we don't want to have to be paying 43% on this money, plus other surtaxes, Medicare, etc. So there are reasons to look at it that way. Now, from a Roth perspective, it is different. You're not taxed on any of that money, so you want to let it sit and grow as much as humanly possible. So that is a scenario where you do want to wait and take out only as much as is required, and then take everything else out after that 10-year period. You want to stretch that money out as far as you can. If it can double over that 10-year period, you inherited $400,000, it doubles to $800,000, you still don't pay taxes on it as you take out that $800,000. So depending on the type of account, how it's inherited, tax, etc., that's going to depend on the answer.
All right. We want to squeeze in one more question. I guess we have a minute or two. Charles in Cheshire. I'm 69 years old, living on a post-tax capital gains from the sale of my business. I'll draw Social Security when I turn 70. My interest and dividend income, about $3,000. I guess that's $3,000 in 2024 this year. I'll take the standard deduction. Should I take a 401k deduction, and how much because it'll be tax-free this year?
I take a 401k deduction. I'm a little confused because you sold the business. So a 401k deduction, like, are you? I guess the question is a little confusing for me. And I'm sorry, Charles, but if your question is, should I take money out of your 401k this year? Possibility, right? You're 69 years old. Again, this might be a scenario where you do look at doing a Roth conversion. If the only income that you have is $36,000 a year from dividends and interest, and when you sold the business, obviously you paid a lot more in capital gains and taxes. And before, when you were running the business, I'm going to assume that you made more than $36,000 a year because, it's hard living in Connecticut on that much. But the assumption is that you're in a much lower tax bracket now than you were. And if that's the case, then yeah, man, absolutely we should consider doing it. But again, as Gary said earlier, this is not a DIY. You do not want to do this one yourself. This is where you could get hurt. And you could talk with us as financial advisors. You can talk with a CPA, but a good CPA that's a tax planner, but you need a tax planner, whether it's an advisor or a CPA, whatever it may be. That's key. Now listen, we're happy to help you with this. We have offices in Middletown, in Middlebury, and in West Hartford. Almost forgot. We also do appointments by phone, by Zoom, whatever works for you. Some people don't want to commit to an hour-long appointment. I get it. Go to taxesandincome.com, schedule a 15-minute phone call, and let's see what we can do to help put you in the best position for retirement.
All right, here's that phone number, 800-380-8985. The How to Retire Blueprint, folks. No cost, no obligation. Get a better handle on your financial situation. Find out what your investments are really costing you because of high fees or commissions, what future tax implications there'll be, and how much income you can securely generate from that once you do move into retirement. The How to Retire Blueprint, a vital part of your retirement planning journey. 800-380-8985. Oh, you just heard from Ben. Go to taxesandincome.com. Another great way to set yourself up on an appointment with Ben, and the team will get back to you just as soon as possible. 800-380-8985, the How to Retire Blueprint. Wow, what a show today. The show has flown right on by. That's a wrap for today. We hope you enjoyed listening to the show. Hope we had some great information for you as well. Look forward to all of you being back next week. We'll have new topics and new questions right here on How to Retire with Ben Fuchs. Been a pleasure, my friend, as always. I'll talk to you next week.
Pleasure's all mine, Gary. Thank you.
Investment advisory services are offered through Foundations Investment Advisors, LLC, hereafter known as Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment, opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor situation is different, and ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio of securities, or investment strategy is suitable for any person. No legal or tax advice is provided. Please review your retirement, tax, and legacy planning strategies with a legal or tax professional before transacting or implementing any strategy discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Security Administration, any federal Medicare program, or any U.S. government agency. If applicable, we do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. All rights reserved.